given. Okay, you can start recording it.
Yeah, started, sir.
Okay. Today we look at the methods of corporate valuation, balance sheet method, stock and debt approach, direct comparison approach, and FCF, future cash flow method. Today we look at first three methods: balance sheet method, stock and debt approach, and direct comparison approach. In theory part of direct comparison approach. And next session we look at the case, how the problem can be solved through direct comparison approach. As the name indicates, balance sheet method based on financial statement of a company, the companies are going to be valued. As all of us know, balance sheet indicates the financial position of a company, financial performance of a company. It shows the source of funds and application of funds. The liability side shows the source of funds. The asset side indicates the application of funds. The major source of funds for a company, as we have discussed the first session, the two ways the company can raise funds, that is the debt and equity, that is the own funds or debt funds. Own funds and a company format, equity share capital, and the company format, debt funds include debenture funds, bonds funds, or long-term loans, or short-term loans, or current liabilities and provisions. So these are all funds, the ways the company can raise its funds. And these funds need to be applied. So the funds, with these funds, the company purchases fixed assets and current assets and investments. So predominantly the assets include fixed assets, investments, and the current assets. Based on balance sheet method, how the company can be valued. So there are two ways the company can be valued. One is take the total assets of a company minus the liabilities of a company. Here the liabilities of a company indicates only the outside liabilities, or we call it external equities, not internal equity, external equity or external liability. So total assets, we have fixed assets, investments, current assets, loans and advances. And one more item that we write, two more items we write, that is miscellaneous expenditure and the profit and loss account. Miscellaneous expenditure, it is not an asset, it's a fictitious asset. Expenditure which cannot be recovered, which cannot be written off, or which cannot be discharged in a particular profit and loss account, particular year profit and loss account, such expenditure can be carried forward. So those items will be recorded under the heading called capital expenditure on the asset side of the balance sheet. So which include the huge amount that a company pays for advertisement or promotional expenditure. For example, the company employs a big celebrity for any kind of advertisement, then the company need to pay the huge amount of money. So for example, Shah Rukh Khan is employed, and Shah Rukh Khan needs to be paid about 5 crore for a 2-minute video or 3-minute video on advertisement. So I mean, Baiju has paid 4 crore. Baiju has paid 4 crore, and Mohanlal was paid 1.5 crore for that 2 minutes 60-second video where Mohanlal comes for Baiju's classes. So huge amount the company pays for the celebrity for advertisement expenditure. So these expenses need not be written in the particular year profit and loss account. That those expenditure can be carried forward. Why? Because the benefit accrue from these expenditure is not related to 1 year. When the celebrity comes for any advertisement, the benefit from these The benefit from this advertisement does not relate to 1 year. It is continuing. It is continuing. So the Income Tax Act says so such expenditure can be carried forward for 10 years. So if you pay 3 crore to a celebrity for advertisement expenditure, 30 lakhs you can write off. The company can write off in every company profit account. The remaining amount, 30 lakhs. So 30 lakhs into 10, 3 crore. 30 lakhs into 10. So every year the company can write off only 30 lakhs. So the first year the company write off 30 lakhs, the remaining 2 crore 70 lakhs, the company, where do they write? Where do they record? It is under the heading called miscellaneous expenditure. Miscellaneous expenditure under the asset side of the balance sheet. Okay, so this is one example. So we call it as the deferred revenue expenditure. Deferred revenue expenditure. So advertisement is a revenue expenditure. It is postponed. It is postponed to subsequent years. So it is called as deferred revenue expenditure. Deferred revenue expenditure. So under the heading called deferred revenue expenditure, these advertisement can be written off. Or we expenditure that the company incurs at the start of the company. We call it as the preliminary expenses. Preliminary expenses. So such expenses can also be written under the heading called miscellaneous expenditure. So these miscellaneous expenditure are not real assets. These miscellaneous expenditure are not real assets. The expenditure which cannot be recovered during the particular year can be written off under the heading miscellaneous expenditure as per the income tax norms. Okay, and the company, any scientific equipment the company pays, a huge amount the company pays, but which is revenue in nature, not capital expenditure in nature. Capital expenditure means it becomes an asset. If it is of revenue expenditure in nature, huge amount the company pays for scientific promotion or the research and development expenditure, those expenses can also be written under the heading called miscellaneous expenditure. They are all revenue expenditure in nature, but the company cannot write off in a particular year profit and loss account because the profit will come down. So to keep up the profit momentum going, to keep up the bottom line going, the company has got an alternative. Company has got an alternative to write these expenditure in the heading called miscellaneous expenditure under the asset side of the balance sheet. So these miscellaneous expenditure are not assets. They are called fictitious asset, not real. Fictitious means not real. So it's not a real asset. So these miscellaneous expenditure should not be added while we add the total assets. And one more heading, we call it as the profit and loss account. Profit and loss account, which is the loss for the company. The profit means we write on the liability side of the balance sheet because it's internal financing. If it's a loss, where do we write? We write on the asset of the balance sheet, asset side of the balance sheet. So which is known as a loss. So that should not be added when we add the total assets. So total assets means fixed assets, investments, current assets, and loans and advances. Total assets minus we have the liability side, we deduct only external liability. We deduct only external liability. So external liability means long-term loans, debts, long-term loans, short-term loans, current liabilities and provisions, and the debentures or bonds. So these are all long-term loans and short-term loans and current liabilities and provisions. We call them as the external liability. So these external liability can be deducted from total assets. Okay, so that will give you the net asset value of a company. So this is the value of a company based on balance sheet. So look at this case, what is given there. Okay, so we have total assets. 1 minute. Total assets is 160. Total assets is 160. Cash, accounts receivable, inventories, and fixed assets. That is 160. The liability side, we have accounts payable, bank debt, long-term debt, and shareholders' equity. That is 80. Total 160. The total assets is 160 because which does not include any miscellaneous expenditure. So 160 minus the 160 minus the external liability. External liability is 40. It is 30. That is 80. Yeah, 80. So 160 minus 80. 160 minus 80 is 80. Got it?
Yes, sir.
Net asset value. One method. Second method is you can just add the internal liability. You need not deduct anything. Only take internal equity. That is the shareholders' capital and reserves and surplus. Shareholders' capital and reserves and surplus. That is the liability side of the balance sheet. So liabilities of the balance sheet, I repeat the heading: share capital, reserves and surplus, long-term loans, secured loans, unsecured loans, current liabilities, and provisions. Okay. So here, what is the external? So here it is not given shareholders equity. It is not given shareholders equity and reserves and surplus. It is given only shareholders equity. That is 80. So net asset value of a company is 80. You just add only the shareholders portion. Shareholders portion is capital plus reserves and surplus. So capital is 80. So the net asset value of a company is 80. Okay, so two ways we can calculate. One is total assets minus external liability, or you just add only the capital plus reserves and surplus. Okay, so 160 minus 80, or only you take 80 alone. So that is also known as the net asset value of a company, or value based on balance sheet of a company. So any method that you can calculate. Got it? Hello? Any clarification regarding this? Hello?
No, sir. Clear, sir.
Clear? So it is given the book value of a company, capital plus reserve is 80 million. It can also be calculated the difference between total assets 160 and liabilities, that is 40 plus 10 plus 10, 30, that is 80 million. So look at the second sentence, it is given there. Okay. So book value of a company, capital plus reserves, that is 80 million, or it can be calculated in another way, that is total assets minus total liabilities. Okay. Now, what is the major limitation of this particular method? This method does not, balance sheet does not take into account the market value of an asset. Please, we need to understand there is no market value of liability. There is no market value for liability. There is no market value for debt. Whatever the company borrows, the company needs to pay. So, for example, here the company borrowed from the bank 10 million. The company needs to pay 10 million. This 10 million does not have any market value unless it's a debenture. So debenture, which is or bonds which are traded in the secondary market, which will have a market value. Whereas the company borrows from the bank, whatever the company borrows, the company needs to pay back. So which does not have any market value. Currently, long-term debt, if it is not traded in the secondary market, so 30 million is its market value. Shareholders equity, it is a book value, based on book value, it is mentioned. But assets have got market value. Fixed assets has got its market value. But we write the balance sheet based on historical cost. The balance sheets records historical cost. Historical cost means cost minus depreciation. Cost minus depreciation. So balance sheet does not record the market value. So in that case, it does not take into account the current value of an asset. Current value of an asset. So when the companies, as we have seen in the previous lecture, the companies are valued for two important reasons. One is when the company is going to be sold, or one company is buying in another company, that is called merger and acquisition. The companies are valued. the companies are valued, or the company is going for taking a loan from the banks, and the companies are valued. So in that case, the company need to project its correct and true value, true and fair value. So the balance sheet does not reflect the true and fair value of a company. Balance sheet does not reflect the true and fair value of a company because it does not record the current market value of an asset. It records only the historical cost. Okay, so these balance sheet needs to be readjusted. It needs to be readjusted. That we call it as a adjusted book value method. Adjusted book value method. So adjusted book value method means that all the assets are recorded as per its market value. So for example here, for example, if we consider that account receivable include 2 million of debt, this means should have value of 8 million. Okay, and the market value of stock, so say for example 52 million. The fixed assets have got a value of 150 million to an expert. So in that case, these values are adjusted. These values are adjusted. So we say accounts payable is 40, bank debt is 10, and long-term debt is 30, capital reserves is 135 as per the current calculation, and then accounts receivable, inventory 50. Accounts receivable is revalued, inventories are revalued, fixed assets are revalued. So as per current balance sheet, what is the value of a company is the 135, that is 250, 215, that is total assets minus total liabilities. Total liabilities is 80, 40 plus 10 plus 30, 80. So the adjusted book value is 135 million. So assets, sometimes it is assets are recorded as per the market value. As per the market value, we need to calculate the the current asset, current value of a company. So usually when this method is taken for valuation, the company takes into account the current market value. In reality, the company does not value its total value not based on historical cost, based on the current market value. So the balance sheets, all the balance sheet is re-rendered or re-recorded based on the current market value for valuation purpose. See, once for the valuation purpose, the company balance sheet is rewritten. Company balance sheet is rewritten for the valuation purpose. Any clarification? Anybody? Any clarification? Anybody? Book value? Book value, adjust book value. Any doubts? Any clarification? So in this particular case, the adjusted book value exceeds by the book value by 55 million. Earlier it was 80, now it is 135. So it is, the value is increased by 55 million. Okay. Liquidation value means another method and the balance sheet. And the balance sheet, another method, balance sheet method and another method. If the company is closed now, if the company is liquidated now, what is its value? So that value need to be undertaken. When the company is closed now, the company is perpetual, the company is everlasting. Sometimes if the company is closed now, what is the value of the company? If the company wants to find out, you can calculate based on this method. Okay, so in that case, we need to have the redundancy payments and other expense of liquidation. Say for example, comes around 60 million. If the company is closed now, what is its liquidation expenses? Say it is accounted, say 60 million. So what's the value of a company? 135 minus 60. 135 minus 60, that is 75 million. That is the value of the company. If the company is closed today, the company is closed today, the liquidation expense amounts to say 60 million. What is the value of a company? Okay. So this kind of cases can be asked in section A question. Section A question, it can be asked, the balance sheet can be given. So calculate the book value or calculate the liquidation value. It can be asked for a Section A case study. So any clarification regarding balance sheet method? So if the number of share is given, the value divided by number of shares, that will give you value per share, net asset value per share. That's what we call it, NAV, net asset value. Net asset value per share, it can be calculated if it is number of shares is given. So for example, number of shares is 100, so 135 divided by 100, so 1.35.
So can you explain adjusted book value once more?
Adjusted book value. So adjusted book value, we need to take into account the current market value. Current market value. Okay, that's what the adjusted book value says. Okay. Current market value, that's what it says. Okay. In that case, current market value. Current market value.
Assets and liabilities. Or
Assets.
it's okay.
Assets. In case of assets, current market value of assets. Okay. In a liability, current market value we may get only for debentures. Only for debentures which are traded in secondary market. Debentures which are traded in secondary market, we get the current market value. Or the debt which may include the bad debts. So in that case, we take into account the current market value. Bad debts, if it is there. Okay. So here the stock is 52 million. Stock is valued at 52 million. Fixed is valued at say 150 million, and bad debt is 2 million. See, so look at that. So accounts payable is 10 account receivable, but bad debts we say 2 million. So 8 million. Got it? 8 million.
Yes.
Okay. So accordingly, we adjust the capital and reserve. So cash is 5. It does not have any market value. Accounts receivable, we say 2 million is bad debt. So 8 million. And inventory is valued at 52 million. Fixed assets is valued at 150 million. And here, the value of why the fixed assets is increased, because the land value. So building does not have a value, as all of us know. Which has got a value? Building value is, for example, you have your own house. Whoever is coming for to buy your house. First of all, they don't look at. They ask when did the particular house construct. Okay, so if it is constructed say 15 years before, so accordingly the building value comes down. The value increases for the land, not for the building. Okay, so they look at what is the value for this particular land, the current nearby locality, and then based on that value, you multiply the number of acres and number of square feet available, and then get the total land value. So the fixed assets value increases substantially because of increase in value of the land. Okay, got it? So otherwise, yes, furniture, system, all these values are, decreased. Values are decreased. So those values are taken into account, because depreciation we always write. So those values are taken into account. Got it?
Yes, sir. But so when valuing these assets, we usually bring in a valuator, right?
Yeah, correct. See, this is not done by the company. An appraiser does.
Okay.
An appraiser does. We call them as an analyst, or we call them as an appraiser. In a big company, these are all services given by Goldman Sachs, Citibank, JP Morgan Chase. Okay, so these are all companies which are specialized for this, specialized for valuing the companies. Okay, they do it for the service. For the service provided, they charge a commission, or the dividend. They buy the shares, they get shares. Okay.
So when that charge comes, will that be considered as valuation charge? I mean,
yes, that need to be deducted. No, that is not considered the value of a company. That need to be paid. Is a revenue expenditure.
Okay.
The revenue expenditure. So from your cash, you need to pay. That's all.
Right. Okay.
So that will not come into picture here.
Okay.
Yeah. So those merchant services, we call them as the, in common language, we call them as a brokerage. So when you buy a house, so you approach a broker. Same way, for a company point of view, the company appoints the professional appraisers or professional valuers, and they come and value the company. Any clarification? Anybody? First method, balance sheet method. Yeah. Second one is a very simple method. That is stock and debt approach. Stock and debt approach. So add the value of equity and value of debt. So that is the value of a company. Stock and debt approach. Here, stock does not mean the inventory. Stock includes stock. Here it means equity value, equity share value. Okay, so share capital value. So for example, here as per this particular case, there is 135, 135 plus the value of debt, the value of not the short-term debt, the value of long-term debt, that is 30. So what is the value of a company here? 165. 135 plus 30, that is 165. That's the value of a company. Very simple method. Okay, so here we need to take into account the current market value of a share. So current market value is 135 and long-term debt is 30. The value of a company is 165. Got it? Hello?
Yes, sir.
Yeah, stock and debt approach is the sum of market value of stock and market value of debt. So market value of debt, unless it is traded in secondary market, there is no market value. Whatever value is given in the book, it's called a market value, unless it is traded. So there is a market value for the shares. So that is called stock and debt approach. Add these two, that will give us the value of a company. Okay, so which is uncommonly used. You cannot find out the value of a company by adding equity and stock. For the theory sake, we study, but it is not used for valuing the company anywhere else. Yeah. Yeah. If somebody saw something.
Yeah, I mean, this method doesn't make much sense.
Doesn't make much sense because how does the company pay? Because this much is your value of a company. That is not a correct valuation of a company.
Yes, sir.
Yeah, doesn't give you the correct value of a company. So it is not used anywhere. For a theory sake, we study that. Okay. Yeah. Okay. Now we look at the third method. I stop sharing it. I'll put the other one. Okay. This method, I have not put it in the LMS. Today, I'll put it. Third approach. This is a third approach that is called direct comparison approach. It is commonly used. It's a commonly used method for valuing the company. This direct comparison approach is based on valuation of a land and building. We take the land and building value. So based on which only this method is derived. For example, a person is going for buying an apartment. If it is the 3,000 square feet apartment values at say 3 million, 30 lakhs, okay, 30 lakhs, 3,000 square feet. I mean, in a town B, we don't get 3,000 square feet for 30 lakhs in town A. In town B and town C's, we will get 30 lakhs, 3,000 square feet. What will be the value for 2,000 square feet? Hello? 3,000 square feet value is say 3 million. What will be the value for 2,000 square feet?
2 million.
Yeah, 2 million. Very good. Who told?
Robbins.
Robin. So Robbins, 2 marks. Sorry, 1 mark.
Robin OS.
Robin OS, 1 mark. So you need to get another 4 marks. What's your number?
155, sir.
155. Okay. 1 mark is given. Okay. Rachana is there? Rachana K?
Yes, sir.
Okay. Sajjan KS? Sajjan KS is there?
Yes, sir. Yes, sir.
Okay. Midun Sibi?
Yes, sir.
Okay. Muhammad Hussain? Hello? Muhammad Hussain. 502073. 502073 is there? 502073. Muhammad? Not there? 5020.
Yes, sir. Yes, sir. I'm here.
There. Where did you go? You went out. Hello? Where were you? You
Yes,
went
sir.
out.
I'm here, sir. Hussein.
No, Hussein is there, but when I called you two, three times, where were you? Huh? You are switching on and going out.
No, sir. No, sir. I'm right home.
Okay. O Vigneshwaran. Hello?
Yes, sir. Good morning, sir.
Morning. You are there?
Yes, sir.
Okay. Darshita,
Yes, sir.
you are there. Okay. Afsal?
Yes, sir.
Okay. What happened, man? You have reduced your body. Yesterday, on the freshers day, I saw that.
No, sir.
You're going for a gym.
No, sir. No, sir.
Your body has tremendously decreased. What happened?
No, maybe it's because of the beard, sir.
Not because of that. I mean,
Actually, I gained weight, sir, sitting at home.
you lost weight.
No, sir, I gained, sir.
No, it doesn't look like that. Okay, I have noticed that. Okay.
Okay, sir.
Take care of your health.
Sure, sir.
Yeah. Then Gayatri?
Yes, sir.
Okay. Elizabeth?
Yes, sir.
Okay. Marilyn?
Yes, sir.
Okay. Mario Clinton? Mario? Hello? Mario Clinton? 3134. Mario Clinton Vinith? 3134. Hello? 3134? 503134. 503134. Mario Clinton is there? So Mario Clinton marked absent. Mario Clinton absent.
No, sir, present, sir.
Where were you?
Sorry, sir. Technically, I was
Sleeping,
talking, sir, not here.
Sleeping. Hello.
Sir, I was talking, sir. Network issue, sir, not able to hear.
Network issue.
Yes, sir.
What, man? In this, post-COVID-19 world, you're talking about network issue.
Sir, there is a network issue, sir, at my place.
Network issues are there. Okay.
Yes, sir.
So what's the difference between stock debt approach and adjusted book value approach? Difference between stock and debt approach and adjusted book value approach. What
Sir,
is the difference?
stock debt approach and
Stock and
adjusted.
debt approach and adjusted book value approach.
Sir, I am not clear with it, sir.
Difference between adjusted book value approach and stock and debt approach. What is that?
Sir, adjusted book value approach means the asset as per the market value.
Okay. Okay.
And
Market value of what? Market value of assets or market value of debts?
assets, sir.
Okay. So why not debt? Why we take only assets?
Adjusted book value.
Why should we take only asset? Why don't we take a debt?
For value, we'll have to take only assets value. No,
I'm asking why we should take only asset value. Why not debt?
Debt is something we'll have to give to others. So this is what we have. So
okay. So whatever we borrow,
yes,
we'll have to pay. Whatever we borrow, we'll have to pay.
Yes.
Correct? So there is no market value of
yes,
debt.
sir.
Correct? Okay. Okay. Now what is the stock and debt approach?
Stock and debt approach one.
How do we get that?
Just a minute, sir. Sir, I'm not so sure.
Somebody is testing you, texting you.
No, sir.
Okay. So you are given 0 mark. Okay. So remaining 4 chances are there to get another 4 marks. So you are given 0 mark. Okay. 0 mark. Okay. So another 4 chances are there to get another 4 marks. Okay. Okay. Now, this direct comparison approach is taken into account based on the valuation of apartments. So the value of 3,000 square feet apartment is derived based, the value of 2,000 square feet apartment is derived based on the value of 3,000 square feet. Okay. So what is the relative value? So whenever we go for buying a land or building, and we look at the value of the land nearby. So the moment we go for buying a land, we see what is the value nearby. I mean, next land, what is the value and at what price. So we try to find out the owner of a nearby land and we try to find out at what price he has paid. Okay. So at that price, we also started finding out the total value and we started negotiating with the seller. Correct? The same methodology is used here. The same logic is used here. The same logic is used here for calculating the value of a company. That's what the name indicates. As the name indicates, direct comparison approach. So the companies, the value based on the comparable companies. Comparable companies. The same way that when we go for buying a land, we compare the value of the land with a nearby land. The same way, or the value of apartment, nearby apartment, or the same apartments, the same apartment, what is the value of, the particular apartment based on which we calculate. The same methodology is used here. So here, the subject company is valued based on the value of comparable companies. comparable companies. The steps involved are, it is very important theory question for section A. It is a complete explanation is given. So I'll put it in the LMS today. So you can see that it is for section B question, for a theory question for examination point of view. The steps are analyze the economy. So we need to analyze the economy before the company goes for valuing the company. The company needs to find out the economic indicators, including gross national product, gross domestic product, inflation, interest rate, and then savings rate, the total expenditure rate, balance of payment rate, balance of payments, and then we look at the foreign exchange rate. So these indicators provide the macroeconomic conditions of the country. Macroeconomic conditions of the country. So before the company comes for buying another company, the company looks at the macroeconomic indicators of a particular country, which include GNP, industrial production, because production is now after a pandemic, it was reduced by 7.5%. It was reduced by 7.5%. Agricultural output relatively very high after this COVID-19. Agricultural output is increasing now, predominantly in the northern part of our country and southern part of our country, and inflation rate is under control now. The interest rate is tremendously reduced interest rate, and then balance of payment. Our import is always higher than the export, because any developing nation import is always higher than the export. Any developing nation, because we import more oil, we import more gold. The gold consumption need to be reduced, and the exchange rate is now it's under control. I mean, when you look at the month of May or June, the inflation, the exchange against the dollar, it touched 79 rupees. It doesn't touch 80 rupees. It touched 79 rupees to increase the value of its exports. And then government budget has been prepared. Now the finance minister is preparing, under preparation of the current already stakeholders' opinion. She started taking for presenting her budget. So budget is also an important indicator wherein that we find out, we look at the total government expenditure, where the government is spending. So these are all the various macroeconomic indicators of a country. Then after analyzing the economy, we need to analyze the industry, where this particular company belongs to. If it is a cement company, the cement industry need to be analyzed. If it is an infrastructure company, the infrastructure industry need to be analyzed. If it is an FMCG company, the FMCG industry need to be analyzed. If it is an ITES company, ITES industry need to be analyzed. Okay, so the relationship of the industry, of the economy as a whole, the stage in which the industry is in its life cycle, is it in an infantry stage or maturity stage or the declining stage? So the industry life cycle we need to look at, and the profit potential of the company, the profit potential of the industry, whether it is a manufacturing industry or service industry or agro-based industry. What is the profit potential of the industry? The company needs to look at the nature of regulation applicable to the particular industry, because every industry has got its own laws, every industry has got its own norms. So what act, what law is applicable to a particular industry, that need to be taken into account. The relative competitive advantage of the procurement of raw materials, where the raw materials can be, if it is a manufacturing company, what's the input of raw materials, what is the source of raw materials, that need to be taken into account. Production cost, production marketing cost, distribution arrangements, and technological resources, all that need to be taken into account while we analyze the industry. Then we need to analyze the subject. We need to analyze a company. We need to analyze, after analyzing the industry, we need to analyze subject company, the company which is going to be valued. So that need to be analyzed. We look at what is the market product portfolio and what are its market segments, availability and cost input, what the raw material, where this particular company is getting its raw material, and their technological capabilities, its market image, the goodwill of a company, customer loyalty, product differentiation, the quality of human resources, and its top management competency, then its liquidity ratio, liquidity position, leverage positions, what are its debt equity ratio, and then we should look at its turnover, its margin, and its return on investment, ROI. So these are all the indicators which provide an analyst to value the subject company. Then, as it was mentioned earlier, we need to select the comparable companies, because every company is unique. So the Mindtree cannot be compared with the TCS. Mindtree cannot be compared with the TCS. Okay, so the Happiest Minds. Happiest Minds is another company, listed company recently during the pandemic, which is founded by Mr. Ashok Soota. At the age of 73, he started a company. At the age of 73, he started a company, Mr. Ashok Soota, who co-founded the Mindtree, and it's a mid-size company. And when he came for IPO at the age of 78, please understand, age is not a limit. So only mind is what really matters. At the age of 73, he started a company, and 69 he started a company, and 78, at the age of 78, he came for IPO. Look at his mental capacity, mental capability. At the age of 78, he came forward for listing the company during this crisis period. During this crisis period, he took a bold step, and his company got listed. A tremendous response from the primary market, IPO, and then it was oversubscribed by more than three times. And it's Happiest Minds cannot be compared with the TCS because it's a mid-size company, mid-size IT company. So when we take the comparable companies on the same size, on the same turnover, on the same profit, the company we should take in those companies. So select the companies which are similar to subject company in terms of its line of business, nature of the market, scale of operations, and so on. We cannot company X, it cannot be compared with the company Y in terms of its market size, in terms of its market operations. On the same level, the company need to be undertaken. So it is difficult to find truly comparable companies because companies are engaged in variety of businesses, serve different market segments, and have varying capacities. Very difficult to take the same. Sorry, I have forgotten to charge the battery, so immediately it has gone. I don't know. Okay, all of you are there?
Yes, sir.
Okay. So
Yes, sir.
it's gone. Immediately it has gone. I didn't put my charger, the laptop. Suddenly, usually it comes, no? Your charge, battery is low, correct? Nothing has come. Immediately it is switched off. Okay. So selecting the comparable company is a very difficult task. The analysts make every effort to look at very carefully at 10 to 15 companies, and then you can select at least 3 to 4 companies as close as possible for valuing the subject company. And then another important is we need to analyze the financial aspect of the subject company and the comparable companies. We need to analyze the balance sheet and the income statement of both the companies, subject company and the comparable companies. And then very important is we need to choose the financial variables. What financial variables on what basis and what criteria the subject company can be valued. So this criteria can be the value to sales. Sales can be one criteria. Book value of assets is one criteria, one basis. Or PBIDT, that is profit before interest, depreciation, and tax can be another variable. Or the profit before interest and tax can be another variable. Or PE ratio can be another variable. or market to book value ratio can be another variable. So based on these financial variables, or we call it as the financial multiples, we can value the subject company. The last step is based on these financial variables, the subject company is valued. Okay, so we analyze the economy, analyze the industry, analyze the subject company, and select the comparable companies, look at the financial aspects of the company, and select the financial variables on what basis the company can be valued. So those financial variables we need to be taken into account and value the subject company. So we take 3 financial variables, and the value of a company will be average of 3 financial variables. Average of 3 financial variables. So if we take 2 financial variables, we can value subject company based on average of 2 financial variables. This is the most commonly method used for valuing the company. But very important is selecting the comparable company is very, very important task, because each company is unique. Each company is serving a different segment, because Ashok Sutak could scale up its operation because of its digital company. Because this company is entirely different from Infosys. This company is entirely different from TCS, because the entire revenue comes from digital business operations. Okay, so Happiest Minds cannot be compared with Mindtree, because Mindtree is a core IT company, but this Happiest Minds is not a core IT company; it's a digital company. Okay, so selecting the comparable company is a very, very important task. If that is successful, then we can use this method. Otherwise, this method cannot be used. Because selecting the comparable companies is very, very crucial task. If that is successful, this method can be employed. Otherwise, this method cannot be employed. Okay. So any clarification, anybody? So that's the case for this particular method. So we will discuss in the next session. The case we can take in the next session. So we will take up the video lecture. The next session. Yeah. Father Eben?
Yes, sir.
You're ready, no? Next video lecture for F5.
So right now I am here here at Malur.
Malur. Okay. And then I'll take here local. Alex will call him. Yeah. When are you coming back here, campus?
Maybe I'll be back here within 2-3 days, but after the project.
After the project, you come. Oh yeah.
No. After the project completion, again I'll come back here, sir.
Okay.
No,
okay.
Sir. Anyway, you record, sir. I can edit later. No problem.
Later, no?
Yeah.
Anything else? Anybody? Anything to be? Yes, it's a Bangalore-based company. Okay, so you read his biography, very, very inspirational. Yeah. So age is not a limit for starting a company. For starting a company, age is not a limit. At the age of 69, he started his company. Age of 69. Okay. 2011, he came here to address our students when he started the Happiest Minds. When he left from Mindtree. So any clarification? Anybody? Anything anybody want to ask?
Sir?
Yes.
Good morning, sir.
Yeah.
Sir, plagiarism check we can do in college, sir.
Yeah, you can do it. You can come here. You can do it here. Or what you can do is today we are sending it the group. You can send to your project guide. Intern project guide will send it to the here Ajit. The lab administrator here. The lab administrator will check, and he will give back to the teacher. The teacher will send it to you.
Thank you, sir.
Yeah. Or you can personally, you can come and take it. Anything is possible.
Okay, sir.
Yeah.
Sir, to come personally also we need to get a COVID test.
No, not required.